The premise here is that the credit cycle is reaching a peak. How do you know that? And secondly, what are the dangers inherent there?
Well, if we look at what's been happening over the last couple of years, so we've seen, particularly last year, was a record year for leveraged loan issuance in Europe and the US. If we look at what's been happening with credit spreads, they have contracted to almost 10-year lows. We've seen a little bit of volatility in the past few weeks associated with trade and related issues. But when we look at that, we look at low interest rates, we look at the conditions that these institutional lenders are lending against in terms of covenant-light facilities, much more relaxed terms. We think that these characteristics are very much part of a late part of the credit cycle. And as a result, at this part of the cycle, you should actually be getting more return because you are taking more risk, you're more exposed to a turn of that credit cycle. But that's not what we're seeing. So whilst it's notoriously difficult to pick when a cycle ends, we look at, it's been almost a decade since the GFC. And when we look at what's happening in terms of these spreads and conditions, we think it's very late cycle and therefore risks are higher.
Well, the thing is, we've had so much quantitative easing out there. We've had asset bubbles or assets really appreciate so much. So is it vastly more, how can I say, destructive in this regard? Because if LIBOR continues to surge as it is, does it make the fallout from that much worse?
Yeah, well, certainly when you're borrowing off very low rates, it doesn't take a big impact in rates to have an impact. And certainly those low rates are what has driven this chase for yield as money flows into your superannuation accounts and whatever and is allocated to these higher risk sectors such as leveraged loans. The weight of that money then pushes yields down on those securities, and therefore the risks are heightened, and we get back into this classic late cycle phenomenon.
Paul, I want to throw up this chart. Rich mentioned LIBOR. I've seen this, 60 plus basis point move in the short-term borrowing costs. What implications do you see, particularly for some of the smaller companies that don't have as great access to capital as their, larger peers? Do you think there's going to be quite a bit of pressure, or is this kind of going to be elevated but then come off somewhat?
Yeah, so, as we look at the last couple of years, exactly those weaker entities have been able to refinance because, capital availability has been very strong. So those marginal credits that in a different environment might otherwise be restructured or default, they've been able to access capital markets and other sources of debt to stay afloat. As they go to refinance or as they run into difficulties, their ability to access capital again in a more constrained environment is going to be much more difficult. So there's a risk that benign level of defaults that we've seen over the past few years could kick up significantly if there's a changing in credit conditions.
Lenti, you cover some of these high-yield companies in Asia. What's the kind of state of the financing environment that they're in at the moment?
Hi, Heidi. So we're still seeing a lot of issuance from the sector. It's just investors are getting more selective when it comes to buying those bonds. So we're just because the yields are rising, and as you mentioned, the LIBOR rates are surging. And some of the weaker guys actually canceled some of the deals. So the market is turning to more of a buyer's market from a seller's market.